Applying support and resistance in candlesticks. Price movement demonstration. Now let's apply what we've learned about both candlesticks and SR. Points A through H on this chart are examples of how we combine our knowledge of candles and support and resistance to better understand how price behaved in the past and how it might behave in the future so that we can correctly predict its movements and profit from them. We'll delve more deeply into both candlestick patterns and different kinds of SR later. The idea here is to review what we've covered thus far on candlesticks and SR, demonstrate how we apply these concepts, and give you a taste of things to come. Here's a description on a running basis. A. June 21st through 22nd. The pair of long upper wicks, a candlestick pattern known as a tweezers tops pattern, which we'll cover later, showing strong resistance level around 1.4400 caused by selling pressure from some combination of those who were along the pair taking profits and short sellers opening new positions. The June 14 through 15 candles show prior resistance around 1.4400. Round numbers have a psychological appeal as natural buy or sell points, so certain round numbers tend to become significant SR points. B. June 23rd. The lack of much upper wick tells us that prices mostly fell from the start of the day. The long lower wick indicates that the pair managed to recover over half of its losses before the official close of the day's trading in New York. The lower wick shows sellers tested all the way down to around 1.4130 before buyers stepped in and short sellers took profits. Think of the long lower wick as a blind man's cane, probing for obstacles. C. June 23rd through 26th. This 1.4130 support level was tested each day as selling continued, but this level held firm. The June 24 Friday candle's lower opening and even longer red body shows continued firm selling pressure, but the roughly equal upper and lower wicks reflect some indecision about how low to go. The June 26th Monday candle is a small light gray, this would be shown in red body, with small wicks, meaning price direction was mostly straight down, but with weakening selling pressure. This weakening selling pressure was confirmed by the rally that followed. D. June 27th. A strong reversal as prices rebound off this support level. The long dark gray, this would be shown in green, body shows decisive buyer control, with prices closing near the top of the day's range, and it engulfs or swallows the prior 2 days' losses. Such candles are called bullish engulfing patterns because they literally devour and recoup the prior day's losses. E. June 30th. Long upper wick again serves like a blind man's cane hitting an obstacle as the market gropes around to locate near-term resistance, combined with the short dark gray green body near the bottom of the daily price range, which means there was little loss on the day, suggests the uptrend is weakening, as indeed it was, as shown by the reversal that soon followed. F. July 3rd through 4th. Taking these two daily candlesticks together, we see that the market opened above the 1.4550 resistance level twice, but couldn't advance. On July 4th, after 6 straight days of gains, and now failing to break through resistance for the second straight day, selling begins and drives price lower, as those who bought earlier sell and take profits, and short sellers begin selling the Euro-USD pair in hopes of profiting from buying it back at a lower price later. We'll explain short selling later on. Later, we'll also learn that this kind of candle, with a small body, little or no upper wick, and a relatively long lower wick, is a signal that price could fall. That is, a bearish sign when it occurs during an uptrend, and is confirmed by the next candle closing lower, as was the case on July 6th. It's called a hanging man. Its long lower wick, topped by a small body, combined with a lower close in the next candle, presents an intuitively clear picture of the market rejecting higher prices. G. July 12th. This is essentially the same form of candle as on July 4, F. However, during a downtrend, and especially after an 8-day-long downtrend and close at what was strong long-term support around 1.4000, this is considered a signal that price could reverse direction and move higher. Or to use trading jargon, it's a bullish reversal sign, called a hammer, as sellers probe lower support but buyers send sellers retreating and recover most of the day's or any other period's losses. In other words, this long lower shadow is a graphic image of the market rejecting lower prices. Once again, the lower wick may have hit bottom. Like the bearish hanging man shown on July 4th, this bullish twin hammer required confirmation from the next candle and got it with the next day's bullish engulfing candle. It engulfed or recouped the prior day's move. It signaled the start of a move higher over the coming sessions. H. July 17th. The candle had a mere line instead of a body, meaning that the opening and closing prices were the same or nearly so, price unchanged. The market ruled undecided, a tie between buyers and sellers. Such candles are called dojis. As signs of indecision, they often suggest a possible reversal of the current trend. This form of doji, with its prominent lower wick that occurs after a downtrend near strong support around 1.4000, suggests a market groping for a bottom. That was the case, as the following days confirmed this bullish sign and buyers took over and sent prices higher. July 25th. This doji with equidistant wicks shows complete indecision or perfect balance between buyers and sellers.